that as about what's ahead. And specifically, I wanted to talk about Barry Habib. And you see his credentials there, the three-time Crystal Ball Award winner. Essentially is, nobody predicts the market 100%, but if there's anybody who comes close, it's Barry Habib, and that's who I follow religiously. And he's always on top of where the market is headed. And I want to talk here about where rates are going, starting with the three factors of a recession. Number one, oil spike, which anybody who has a car understands what's going on there. The second one is employment bottoms out and it starts increasing. Okay, we're right now bottoming out, and somewhere here this year, towards the end of the year, it's going to start increasing, and that's where the recession is going to hit. And then the inverted yield curve, it's kind of nerdy, but that's when the short-term rates are higher than the long-term rates. This video here goes into more detail if you really want to get into it, but for time's sake, I just wanted to point out those three factors of a recession. The R word, what does the recession actually mean? And that's just a period of temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in gross domestic product in two successive quarters. So what happens to the mortgage rates during a recession? Like right now, again, if you've been paying attention, interest rates have jumped essentially 2% on a 30-year fixed. And they're still creeping up. We're not sure where they're going to stop. But here's where it's very important if you are an agent and you represent buyers, or you are someone who's looking to buy a home and you're sitting on the fence and you're saying, oh, I don't know if I should really buy right now. So I'm doing some math here, and assuming someone bought a $500,000 home appreciating at 9%, which is what the average was in that chart. Again, I use 4%, but I'm going to use 9% because that's where we are right now. If you bought that home, it's appreciating $45,000 per year. Now, the difference between the interest rate of 3.11 and 5.27, you see there is $500 a month times 12. That's $6,030 per year. So what that's saying is you are going to be, by owning the home, your home appreciation is going to be outpacing the difference in the interest rate by a lot, almost 9 times. And I just did a 5% down for some of the first-time home buyers that don't have the 20% down. You're still going to be sitting pretty. And this is essentially what banks do. It's called arbitrage. You are getting an asset at a high rate, but the lower interest rate is not outpacing that appreciation. So it's still a great time. There really isn't a bad time to be buying real estate. So if you're sitting on a fence, just look over this, read it, reread it, go with numbers, and you're still in a great position, even if the rates go up to 6 or 7%. That appreciation on that asset, that's real equity that's going to be working in your favor. The I word, inflation. That's the increase in cost of goods and services over time. Anybody living right now, buying groceries, buying gas, whatever. We are in an inflationary period. The Fed is trying to get a handle on that. They probably got started too late, increasing the prime interest rate, but that's neither here nor there. So real estate is one of the time-honored inflation hedges, which may be a revelation to a lot of people. But it's a tangible asset, and those tend to uphold their value when inflation reigns, unlike paper assets. More specifically, as prices rise, so do property values, as I've shown you with all of these slides. So let's just look at how the home prices have done versus inflation going back 50 years. And except for one, really, in the 2000, which is that big crash, 2008, the home prices have always done better than the inflation rate. The appreciation rate, home appreciation rate, has done better than the inflation rate. Let that one sink in. Study it, learn it, be it. All right. And the impact of rising rates on home prices. This is going back to the 1993 October. And again, you see that home prices are appreciating during an inflationary period. They take out that 2008, and it's always been positive. That is the one time where it was kind of an outlier, and that was because the housing market was really the cause of the crash.